we say invest in what you know best. So if you are a real estate expert and it's something that you know, or if maybe you've been in the mortgage industry and you know notes and you want to buy performing and non-performing debt, you can do that. So invest in what you know really well. There are other asset classes I can go on, but you invest in what you know, and then you've got a better idea of what the risks are and how to how to navigate that.
All right, guys, welcome to another episode of The Report. Today, we got some sunshine out here in Southern California, and I feel like it is officially the start of summer. We got Memorial Day weekend coming up, and I am so excited. But I am even more excited for our special guest today joining me live in the studio. She's doing big things in the financial space, and she's going to teach us all about what the system doesn't want you to know about the $40 trillion locked up in retirement accounts. She is the CEO and founder of uDirect IRA Services, over $1 billion with a B assets under management. We got my girl, Kaaren Hall. Kaaren, welcome to the show.
Hey, Rich, thanks a lot.
Yeah, appreciate you coming on. And it's just a short jump up the street from Orange County down here. So thank you for coming on.
Yeah.
Long time coming.
I just breezed down. I couldn't believe there's no traffic.
Yes, I know.
Yeah.
Okay, so first things first.
Yeah.
There's a lot of stuff going on right now in the economy. There's a big shift in demographics that's occurring across the world right now. 40 million retiring baby boomers in the next 6 to 7 years. They are calling this the greatest transfer of wealth in American history. And one thing that's very interesting is we got $40 trillion locked up in retirement accounts right now. I know I had an 11-year government career where I invested heavily into a 401k. That was my seed money to get into alternative assets. That was my seed money to get into real estate investing. And so what is going on with the $40 trillion in retirement accounts? Like, how does this even happen?
Yeah, I mean, we've been saving and we've been told, I think it probably started, I'd say 50 years ago or so when they created the IRA. I mean, we've had pensions and things like that, but in 1975, they created the IRA. And ever since then, people have been using that plus plus the plan that they have at work to invest, in Wall Street and mutual funds and things like that. So, you're working, you want to save for retirement. So you start putting money away and not really thinking about where that money is or who's managing it or how it's actually performing. You just do it and then focus on your life. And that has created this giant pool of money. Now, there are other people who are obviously very focused, very determined about what they're going to do with their retirement. And they may be invested in, different kind of vehicles, not just IRAs or 401ks, but maybe defined benefit plans for businesses, something like that. So a lot of different kinds of plans to invest in. But IRAs, it's something like of the 40 trillion, IRAs are about 14 trillion of that. So it's bigger than 401ks now.
IRAs are?
Mm-hmm.
What is the difference between an IRA and a 401k?
Right. Well, a 401k, it's set up differently. It's a different structure. It has two buckets, like an employer portion and employee portion, and it's for businesses, and an IRA is for individuals, like IRA individual, retirement account. And so it's just for an individual person. So you can have an unlimited number of IRAs too.
Got it. Okay, so if you're self-employed, let's just say like a real estate agent, for example, the IRA is going to be your path. But if you're an employee of a firm, there's going to be likely a 401k that's involved with that, correct?
Yeah, correct. It could be a 401k. You probably had like a 403b maybe.
I had a 401k,
Did you?
and it was through the Thrift Savings Plan, the TSP.
Yeah. Or it could even be, there's the 401k, 403b, and the 457 for governments. So different kinds of retirement plans. But yeah, and so if you're a realtor, and you could have a solo 401k and use that, it lets you contribute a lot more money and it has a lot of bells and whistles on it.
Yeah. I had a 401k for an 11-year career. And to give you guys like an idea of the taxes and the penalties I paid to cash that out, it was taxed as ordinary income tax. And I had about $340,000 in there. The Fed taxed, it was a penalty of 10% to the Fed, 2.5% to the state of California. The rest of it was taxed as ordinary income. And at the time when I cashed it out, this is in 2019, they said you could cash out everything except for, and I did a what's it called? A hardship withdrawal. That's what they called it. An in-service hardship withdrawal. You just go to the website and I just said, hey, like I need money. I didn't say I was going to use it to buy real estate, but I'm like, at the end of the day, this is my money, right? Why can't I access my own hard-earned money? but they said you can take everything out except for the employee match that had compounded over the 11 years. And so I there was like it was about $102,000, I believe, that was trapped in there at the time. And I got lucky because the next year was 2020. And when COVID dropped, they came out with this thing when they said, hey, you can, for this like small window, you can now withdraw everything.
Right.
And so I went in there and just hit the withdraw button online.
Oh.
I took out everything.
Now that is not self-directed, okay? Just for the audience. Yeah, but that's cool. I mean, obviously, I mean, you did well. So
But I took a risk, right? I
yeah,
took a
yeah.
risk. And luckily it paid off. But the reason it worked out for me is because it forced me mentally to go all in. I knew when I was pulling out that money that mentally I was like, okay, like this has to work. This is the option
Yeah.
of it not working is not an option for
Like
me.
burn
It
all the
has to work.
ships, right?
Yeah, you're burning the boats and
Yeah.
you're going all in. And so mentally, like I was going all in, and that was me committing. I wasn't dabbling my feet in to see, oh, real estate investing, I'm interested. Let me see if it's going to work. Let me do it as a side hustle. I was like, no. I'm going all in. Like rain or shine, this has to work. And the truth is there was a lot of mistakes and a lot of pivots along the way. And there's, dozens and dozens of fires you got to put out every single week. That's just part of the game as a real estate investor, as part of the game as an entrepreneur. It's to be expected, but and success is not a straight line. But guess what? We always figure it out. If your back is up against the wall and if you don't have a plan B, you will figure it out.
Yeah, every time.
Yeah, I'm a big believer in that. So I want to talk about the history of the 401k system. I believe it was born around the 1980s. What is the history of the 401k system? What was the purpose of it? Because prior to this, there was pensions, right?
There were pensions. Yeah, in fact, it's something like it goes way back even to the Roman legions. They had pensions, and I mean, so retirement is something that has been a thing for a long time. And even the Presbyterian Church had this like retirement fund for widows and orphans, and so but then the government, since the Industrial Revolution, right, and also I think it's like since the 30s, we've had more retirement vehicles, come into play. So 401ks have been great. Adding IRAs are great. And then adding new things along the way, like the Roth IRA, is the newest that we have, the Roth IRA.
Yeah,
Tax-free.
and that's an option for it's like post-tax dollars, correct?
Yeah, and it grows tax-free. Yeah.
Yeah. Okay, so since the 1980s. Now, I will say this, Kaaren. If you look at the average 401k balance in America today based on age, so if you're in your 30s, your 40s, 50s, 60s, 70s, I'm going to pull this up as we speak. To me, it shows that the system is broken.
I mean, the system's based on the stock market. The stock market's super volatile, but at the same time, the stock market does grow. So I'm not saying it's a bad thing. In fact, I heard a speaker last September talking about how a lot of times the stock market has really been a hockey stick, traditionally. So the stock market's not a bad thing, but it has a lot of volatility. So it's not always going to be a hockey stick. And so if you are like just right at the precipice of retiring, you don't want to have a black swan event, something where the market goes down. You just can't time that. And that's why people like alternative assets, because you choose the asset, you have a little bit more control. Of course, there's always going to be risk, right?
Yeah, there's always going to
in
be risk.
every asset. Yeah. That's
Okay,
just
so check this
investing.
out.
Yeah.
This is the actually this is the average. I want to see the median. What is the median 401k balance? This is the average.
I would put
a lot
it,
of
I
this
would
stuff is
guess
on average. Okay, well we're just going to roll with the average.
$67,000.
I wanted to see the median.
Yeah, let's hear.
But this is the average. Everything I'm searching online is showing me the average. So we're gonna roll with the average. All right, this is the average 401k balance for Americans based on how old they are. So for folks between 25 and 29, it's 24,000. For folks between 30 and 34, it's 45,000. 35 to 39, 73,000. Ages 40 to 44, 109,000. Ages 45 to 49, 152,000. And then here's the kicker. So ages 55 to 59, 244,000. And then 60 to 64, 246. And 65 to 69, 251. 70 plus is 250. So after 55 to 59, it levels off. And the average is about 250. The median has got to be a lot lower than that. I guarantee the median is a lot lower than that. I think there's some that just have a ton of money in their 401k, but I would say the median is significantly lower than that. But let's just take the average. So $250,000 at retirement age is the average. And what do they say? The 4% rule is what you're going to live off of?
Well, they talk about that, yeah, and I've heard variations on that, but you just can't do that.
How are you going to live off of 4% of that? So you're telling me I'm going to live off of 4% of $250,000 What does that come out to? 4% times 250. We're looking at, is that right? $10,000?
Yeah, that's not
Is that
possible.
right?
Yeah, well,
So you're telling me I'm going to live off of $10,000 a
no,
year before paying income tax. And by the way, that money's going to be taxed. Okay. And so let's just say it's $8,000 post-tax. That's less than $1,000 a month. And oh, by the way, this is in 25 or 30 years from now when there's going to be a lot more inflation. How is that a system that works?
it doesn't, does
It
it?
doesn't work.
Mm-mm. That's why you need, like for myself in the retirement space, I really was asking myself, how am I going to do it? And so I thought, well, there really are layers of income that you want to have in retirement, just like we have, you've got multiple streams of income and a lot of people do. So, there's like Social Security, and then another layer would be maybe your 401k. An IRA is another layer. Maybe you've got whole life insurance with cash value. Then you've got your assets. Maybe you own a boutique hotel. Maybe you own some, some rentals or something like that. Or you've got other investments like syndications or something. So just all these assets and the passive cash flow, you layer them like you do pre-retirement so that you have enough.
Yeah. Do you think that the 401k was built for Wall Street?
I think so, yes.
You think so?
Yeah, I really do. I mean, I love that you said that because it's really true. It's so about Wall Street. And with the self-directed IRA, it's sort of like the best kept secret. And why is that? And it's because Wall Street really doesn't want you to know. But after right when I got into this space about 2007, Wall Street started to get clever about it. So you would call your exiting custodian. We don't have to name anybody, but you call the custodian and say, hey, I want to move my money. And they say, well, why? And you say, because I want to self-direct. Oh, you can self-direct here. Really? And what they mean is that you can, but you can choose any stock you want. You can choose any market correlated asset you want or any mutual fund that you want. They don't mean truly self-directed, like investing in syndications or notes or
Yeah.
crypto or
You
something.
can
Yeah.
self-direct amongst like 6 or 7 different options. At
That
least
they
that's what it
pick.
was for mine.
Yeah.
It was like, okay, there's a fund that mimics the S&P 500. There's a fund that mimics the Dow Jones, the NASDAQ. And there's a fund that mimics like more conservative, like long-term bonds. And so they would say, hey, like as in the earlier parts of your career, invest in more of the S&P 500, that type of stuff, higher risk, higher return. And then they said, as you got near closer to retirement age, then they would say, diversify and get more into the long-term government bonds because you don't want to take a big hit. And the worst thing that you could do if you're 2 years from retirement is go through like a 2008 and lose 60% of your 401k balance. And so they would say, go to more of a cash position at that time. But it's like, yeah, it's not really how you win the game as an investor, as an entrepreneur.
And you can't time that.
No. You can't. So it's interesting that you said this is what they don't want you to know. And the way they're framing the 401k is differently now. I do believe that it is somewhat of a system. I believe the whole thing that's set up is a system, right? And I'll prelude with this. You got 3 components. You got Wall Street, you got the central banking system, and you got the U.S. government, okay? And so what do they tell you from a young age? I was taught this way too. Go to school, get good grades, go to college, get a job, and after you get a job, go buy a single-family home, invest in your 401k, diversify. But think about all that. When you go to college, now they're going to get you locked into student loan debt. That's cash flow for the central banking system. And then when you graduate, you go get a job, they're going to tell you to go get a high-income earning job because you go to college, get a high-income earning job. Well, when you get a high-income earning job, you now pay the highest tax bracket. That's cash flow for the federal government, okay? And then what do they tell you? They say, go buy a single-family home, get in a 30-year mortgage. That's cash flow for the central banking system. And then they say, play it safe, diversify, invest in your 401k, get the company match, invest in Wall Street. That's cash flow for Wall Street. And so I believe the system has an alignment of interest to breed middle-class people, because without middle-class people, that central banking system doesn't survive, the federal government doesn't survive, and Wall Street doesn't survive. And so I believe those 3 components run the entire world, and they have an alignment of interest to breed middle-class people as a function of it.
Yeah, so middle class is the engine.
Middle class is the engine.
Yeah. Well, you're not even talking about the fees too. With 401ks, there are so many fees you don't see. So your 401k is making money or making profit as it grows, right? And but you're getting feed on every exchange, every transaction. You can get feed in ways you don't even see.
And that's one thing that a lot of people don't talk about. It's like, okay, well, I'm investing in my 401k, and it's like, yeah, it's your money, but regardless if your balance goes up or down, they're making fees. In 2008, when everyone's 401ks and IRAs got slashed by 60% and you took a serious bath, your custodian who has your 401k and IRA, they still made fees.
Yeah. They're
So
getting
this
paid a percentage, right?
getting paid a percentage. And so I don't know. I believe, obviously I'm speculating. I'm always want to be wrong, but I believe that the system has an alignment of interest to breed middle-class people as a function of everything I just mentioned. What are your thoughts?
I never heard of it that way, but I've heard, the creature from Jekyll Island, and it makes sense.
That's a good book, by the way.
Oh, well, have you read the whole thing?
I haven't.
It's like War and Peace,
It's
man.
hard to read.
I don't know anybody who's gone through the whole thing.
It's
pretty
hard to read.
intense. Yeah. So 1913, that's when they obviously created, the Federal Reserve. That's when they created income tax. And this whole thing started, this engine that you're talking about. That's really when it started. And like my grandparents, they didn't have a 30-year mortgage. They would put 80% down, maybe get a 20% loan. It was very different, but having to have a payment every 30 days, that is a modern world kind of a thing.
Yeah, no, it is. It is. So I'm curious, only 4 investors are using this tool, right? We just talked about all the downsides of traditional 401ks, traditional IRAs. Only 4% of investors out there are utilizing this strategy. And this is the hack. This is the way around it. What is the hack?
The hack, I mean, it's self-direct because it's choose these assets that you know best. And first off, we've got fees for the account, but it's a flat fee. It's not a percentage of assets under management. So we don't penalize you for doing well. It's just a flat fee every year. So you get to keep more of what you earn to start off with. And then you can choose your own assets. And we say invest in what you know best. So if you are a real estate expert and it's something that or if maybe you've been in the mortgage industry and notes, and you want to buy performing and non-performing debt, you can do that. So invest in what you know really well. There are other asset classes I can go on, but you invest in what you know, and then you've got a better idea of what the risks are and how to navigate that.
And so with the self-directed IRA, give me an example of some of those alternative assets that maybe most people wouldn't know.
Yeah, they're the basics, right? So, real estate, you could buy a house, you can buy real estate in all its forms. And a lot of times that's done through a syndication. And that is actually the most popular thing. A syndication is the most popular asset class. But secondly is notes, where your IRA can lend money either secured or unsecured. And
So it could do a promissory note.
yeah. Or like say somebody's moving and your IRA can make a bridge loan,
Yeah.
to somebody where they're in between,
Yeah.
that kind of thing. Your IRA could do that.
And it could be with a personal friend or a neighbor.
Right,
Wow.
right, exactly.
That's
right.
pretty cool. And so you said real estate, you mentioned you could buy a house. Can you buy a single family house that you live in as a primary residence?
No,
No.
there are rules, and of course, the IRS, there are rules. So they're called prohibited transactions. And I'm going to throw this out there. The rule book, it's IRC 4975, Internal Revenue Code 4975. If you want to, look it up, talks about all the prohibited transactions. So no personal benefit, no self-dealing. You just have to keep arm's length. So if you're, say, for example, you're raising capital and you're a GP on a deal, your retirement money cannot go into that deal because you're providing services to the plan and you're getting paid on that deal. So you're receiving personal benefit. And that's a prohibited transaction. So I always talk about, keeping it arm's length,
Yeah.
any deal.
Honestly, like if you're a GP,
Mm-hmm.
then like the odds are it's your primary business. At least it should be.
Yeah.
I wouldn't suggest anyone listening to the show to go invest passively with someone that's like they're doing that as a hobby and that's not their main hustle. It should be their main hustle. And if it is your main hustle, then I think maybe you do what I did. Just cash it out. And then once you cash it out, you can use that to invest in your own deals and do your own thing. But if that's like your vision, then like you should go all in. But I think for the majority of people, that the best use of their time is to go work their career. Maybe they're a high income earner. Maybe they're self-employed as a doctor, an attorney. Maybe they're a business owner. And that is the highest and best use of their time. And that's what they love. And that's what allows them to have the freedom to hang out with their kids and provide for their families. Then I think this is the best alternative.
It really is. I mean, it really, really is. And it gives you so much freedom. And there are different kinds of accounts. I was mentioning before, like for a realtor or a self-employed person, something like a solo 401k, where you can make like up to $70,000 and more contribution to this, and have that be maybe get a tax break or put some into the Roth component of this and have it be tax-free for life. So you can have both in one account, which is a 401k. And the 401k also lets you borrow from it for personal use. So you can borrow the lesser of 50,000 or 50% of the value of that account. So you could take out 50,000 cash, do whatever you want with it, like, for example, put a down payment on a rental property
Mm-hmm.
personally,
Yeah.
and then use that to start building your passive portfolio.
I like that. And to be honest with you, like when I was getting into the game, I bought two of my properties that I still own today with the primary residence, no money down, Navy Fed credit union loans. And yes, they're for primary residences. I did live with both of those properties for a little bit. And the loan docs don't say like how long you have to live on the properties and when you can move out. But now those are both Airbnbs today that have paid me every single month. I've gotten cash flow depreciation tax benefits, and they're in great areas of San Diego. And oh, by the way, real estate in San Diego doubles every 12 to 15 years like clockwork if you go back the last, 80 years. And I got them for no money down. And so that's why I say, like, I think for anyone that has a 401k or an IRA, you likely have pretty good income, right? Either W-2 income or you're self-employed and have decent income. Otherwise, you wouldn't be putting money away if you didn't have decent income. Go and see if you can qualify for some of these primary residence loans. And it's no money down, right? It's no money down. And so maybe you only have to take a small 401k loan, or maybe you don't need to take any loan. Get involved and then self-direct, roll it over to a good custodian, someone like Kaaren's company, uDirect IRA Services. By the way, shout out, one of our investors is a client of yours. And so go roll it over to a good self-directed IRA and then use that as a vehicle to get into alternative assets to where you can get cash flow and grow your wealth long term.
Well, we all love real estate, and you talked about the growth and depreciation. It's crazy, and that's the long-term play. And of course, retirement accounts are all about that's long-term money, and so it's just a perfect marriage right there.
It is the perfect marriage. Okay, so give me like some like off the beaten path investment vehicles that you can invest in that you've seen done in the self-directed IRA pool.
Yeah, going way back. I mean,
what's the weirdest thing you've seen?
Yeah, I think probably this kid, which young guy, had a Roth IRA, took it and bought tickets to the Super Bowl. Now, I don't know if you know this. Do you know that tickets are real estate?
No.
It's a lease on a seat. It's considered real estate.
Oh, to go...
A ticket.
At where?
Anywhere. Like if you buy a ticket, like a seat for something, a ticket is considered real estate.
Really?
Yeah.
Like if you're buying a season seat?
Yeah. Or just any ticket. Yeah.
Really?
Yeah, it's real estate.
So you can use your self-directed IRA?
Yeah. So this kid did this. So he bought tickets to the Super Bowl in his Roth. So he that was an asset. Now, I don't know if any custodian today would take that, but at the time this happened. And so what he did is he ended up selling it for a profit. That profit went back into his Roth IRA and grows tax-free for life.
Wow.
Pretty cool, huh?
Wow, that's crazy.
Yeah, it's
so
the craziest thing I heard about.
Super Bowl tickets through his self-directed IRA.
Right.
Wow,
Yes,
that's
yeah.
crazy. That's crazy. Could you still get away with it today?
It depends on the custodian. They say what is and what isn't administratively feasible, like
Mhm.
as a business decision for that company, what they will and won't custody. So yeah.
Wow, that's so crazy. And so he bought the tickets,
Mm-hmm.
flipped them because it was the Super Bowl. You could sell them in a secondary market for a lot more than what face value was. And then the returns went back into his self-directed IRA and they continue to grow tax-free.
Yeah, exactly right.
Damn, that's so crazy.
So
That's
smart,
an odd
right?
one. That's so cool. Hey guys, we just got another boutique hotel under contract in my hometown of San Clemente, California, located not too far from the beach. This will make 5 boutique hotels in our real estate investment fund. So if you are looking for passive income and tax benefits, visit summerscapital.com/invest to book a free call with my team. Again, that's summerscapital.com/invest to book a free call with my team. Now back to the show. And then note investing, that's got to be pretty popular, I imagine.
Oh, it's super popular. And, you were mentioning at the beginning about how we can reinvest in businesses. And note investing is one way that happens. Like we've seen during the Great Recession and then again at, COVID, we see the mom and pop shops close down. And it just makes me so sad as an entrepreneur myself. You can just imagine the family behind that. So they want to rebuild, and your IRA can actually help, like rebuild America. IRAs really did that after the Great Recession, loaning money to these small businesses and using that as seed money to get back on their feet, to get that business running again.
That's really good. And then can you invest into startups if they have like a round to where they're going to bring in investors and give them equity?
Absolutely right. A capital stack. Yeah, the IRA can be part of the capital stack. Now, if You want to, if it's not real estate, you can only invest or you can only raise 25% from retirement accounts. Real estate doesn't have that level, that
That cap.
barrier. Yeah, yeah.
Okay. Now there's something else that's in play here. I know this is a thing because I would say out of our real estate fund, about 20 to 22% invest through a self-directed IRA. And so there's a UBIT tax, right?
Yes.
What the hell is a UBIT tax?
Right, it's a way to get double taxed. Okay, I mean, but we'll talk about it. It doesn't have to be a bad thing, but it exists. So UBIT, unrelated business income tax, and its twin, sort of, fraternal twin, unrelated debt financed income tax, UDFI.
Okay.
So
Most
right,
people have never heard that before.
right, yeah, and you get surprised, and a lot of times, asset sponsors won't tell you. It could be mentioned in the operating agreement, but it isn't always. So you really have to keep your eyes open in a syndication. So, right, we talked about capital stack. So part of that is leverage, that from the GP there. And so what it does, this is how it works. UDFI, the percentage of debt, say it's like 20%, and now your IRA makes $1,000. Well, 20% of that, this is simple math, was earned because of leverage. And so that 20% amount is subject to this UDFI tax, which is super high, like between 17 and 37%. So your IRA files a 990T, you have your tax person, you work with them, always work with your tax person,
Yes,
on this.
always, always.
Yeah. And so you file a 990T and you could take deductions, so you may not owe a lot of tax. Your IRA would pay any tax that's due. But as long as your IRA has that asset, it's a year and a day after your IRA is going to file that 990T. So it's not income tax, it's different tax, but it's UDFI tax.
Okay,
Yeah.
so with let's just say our real estate fund here at Summers Capital, we will get cost segregation studies done on all the hotels in the fund, all the boutique hotels, and the depreciation flows through to all of our limited partners. Now, if one of our investors invests through a self-directed IRA, can they utilize the depreciation that flows through every single year to offset the UBIT taxes?
They should be. I would be calling Amanda Hahn right now. Yeah.
Okay.
Because it's tax
They
question.
they
But
can
yeah,
expect to.
they can. Yeah, I would.
They can
Yes.
expect to.
Yeah.
So that's the workaround then.
Mm-hmm.
That's the workaround.
Mm-hmm.
Mm. Yeah, real estate's a beautiful thing. The depreciation is like, I think a lot of people get into real estate investing and they think, oh, it's all about the cash flow. Like, no, no, no. Real estate is about understanding debt and taxes. And I think once you understand the game of debt and taxes, it can be a very powerful thing.
Yeah, we're so incentivized to invest in real estate, right?
People always ask me, they're like, hey, like, what would you ever get into a boutique hotel like internationally and like, in Europe and like down in Colombia? And I'm like, dude, no, because like our investors and myself included, like I want to invest in US real estate because we understand the tax advantages here are like second to none. And even though we've been in a high rate environment for the last 3 years, the rates here are still much more competitive than most countries around the world. I mean, go to Turkey right now, you're going to pay a 25% interest rate to buy real estate, which means you got to essentially pay cash for that boutique hotel out there in Turkey. And so, think about the multiple that we get on real estate here. Typically, on average, you're putting, 25% down. Hotels, typically, you're going to get like a little bit less leverage. But let's just say on average, real estate, you're going to put 25% down, even 20% down here in the States. You're getting a 5x multiple on your return. Out there in an area like Turkey or some of these other countries that have these high rate environments, you can't pay a 25% rate and make the numbers work. You have to pay all cash. And so that investment out in an area like Turkey would have to do 5 times as good in terms of performance as a real estate investment here just to break even.
That's crazy.
And so that's the one thing you got to ask yourself when you're like, oh, I'm going to go invest out of country and do this and that. I'm like, people don't realize, even with the highest rate environment here, it is so advantageous to invest in a real estate here in the US because of it.
People ask us a lot of times too about self-directed IRAs and investing in foreign countries, and you can do that. So say your IRA bought that Turkey, that boutique hotel in Turkey, that would be great. But you'd avoid taxes. It would be tax-free, tax deferred in the account, but Turkey might charge you taxes. So your IRA would have to pay whatever Turkish taxes are due, and you would not be exempt from those.
Yeah, that's a good point too. And also, like, it's like, exit strategies. We know what the demand's going to be like here in the US. We know what the market fundamentals are, and we know what we're getting into. We have a very, very clear understanding. We have, hundreds of thousands of comps in the country and historical data to go off of. But going into some of these international markets, it's like, we can't control if they have a big change in politics. What if their political system changes? What if they have a new president comes in and changes the way things are done? It's like we like to invest in areas to where we have a clear understanding of what our future looks like. And I feel like with a lot of these foreign countries, you don't have a clear picture of that. And the interest rate thing is a whole different ballgame to ask yourself.
You have to have a pretty high risk tolerance. What do you think?
Yeah, and I think if it's your own money and you're like, hey, dude, like I want to go do a cool deal and it's just my money internationally, then I think that you should be able to do that. But if you're raising money and you're a custodian of other people's money, it changes the way that you do things. Yeah, you got to be more conservative for sure. Anyways, okay, so next up, I want to talk about what are some like other creative things that you can invest in, not in your like IRA stuff, but like just leveraging with your company. Like what else do you guys do outside of just the self-directed IRA?
We do the self-directed
That's
IRA.
that's the one thing that you guys do.
That's what we do.
Okay.
Yeah.
Anything that's like out of the norm that we haven't talked about?
Not really. I mean, we haven't talked maybe about precious metals. I mean, it's not really out of the norm, but precious metals, crypto, maybe tax liens, where it could be, I can say the word, a municipality has a bunch of tax due and they want a liquidity event. They want all that cash. They can sell the right to collect these tax liens, pennies on the dollar. So your IRA can acquire those. Tax liens, it's something you really want to learn about before you do it. Very fee intensive if it's in an IRA. So people will use what's called an IRA owned LLC or a checkbook IRA to do that. But your IRA can buy these tax liens from a municipality and then collect.
And what is a tax lien?
Right. So say, for example, you owe San Diego County like 10 grand. And so they've got the right to collect 10 grand. They sell that right to your IRA. Now your IRA can, collect 10 grand, little bits at a time, but you only paid 8 grand for it. So you paid $8,000 to to be able to collect 10. Yeah, exactly.
So you could potentially make a 25% return.
That you could. I mean,
but you could also take a loss, right? If you never collect it.
Yeah, that's right.
Okay, so you can use and then okay, so how does it work on the back end? So on the front end, we know, okay, there's a lien, we can buy it for 8,000 and we have the right to go collect 10,000. The IRA will fund it. And then who does the collecting?
Right. The IRA can hire a third-party collector.
That's how you do it.
Yeah.
Got it.
An agency.
Okay.
Yeah.
That's pretty cool. What's the biggest tax lien that you've seen someone invest through in IRA?
That's something that's invisible to us most of the time because they are doing it within the confines of a special purpose LLC. So we usually don't see that. Yeah.
Got it. Now, what makes someone eligible to roll their funds over to a self-directed IRA if they already have a pre-existing IRA and they're currently employed with the employer? What does that kind of look like?
Well, if they're working somewhere, if you have a 401k, you could do what's called an in-service transfer. You talked about that, so if you're working there, you're in service, and whether or not you can have this in-service transfer is written in the plan document of that 401k, so it's in the contract. So you ask that administrator, hey, can I have this in-service transfer? And they'll let you know yes or no. So
is there like a hack to getting them to approve it?
Not that I know of, but if you work for company A and then they bought company B, right? And so you worked at company B and now you want to take this 401k. Well, the money that you brought over from the previous company, a lot of times that is money that can be released to you in an in-service transfer.
I see what you're saying.
And a lot of times the rules say that if you're 59 and a half, you can have that in-service transfer, but it is different plan to plan.
Yeah. It's funny because honestly, a lot of people that we talk to, even like friends in my personal network, a lot of them have a 401k or an IRA sitting around collecting dust from an old employer that they're no longer employed with, and they've completely forgotten about it. They don't even know how much money is in there. They don't know what they're invested in. They don't even know the login, right? And I would say that's a lot of people out there. So if you're listening to this right now and you got, an old employer, maybe you got a couple old employers that you had 401k money invested into, like go figure out, go track that money down because it's sitting there and you might as well roll that into a self-directed IRA and put that money to work because that's real money that you can utilize, you can borrow against, you can use it to make more money. And so go figure out where that is. Most people don't know, but those are the best candidates to roll them over, right?
They really
From
are.
past employers.
Yeah, but if you have an IRA, there's no barrier. You just do a custodian to custodian transfer. If you want the money really fast, sometimes this will happen. They'll do what's called an indirect rollover, where the money
What is
will
that?
come. It'll come from the custodian directly to you. You put it in your bank,
Okay.
And the minute that happens, that's going to create a situation where you get a 1099, which means you're going to be taxed. But if you get the money back into another retirement plan within 60 days, you don't pay the tax. But typically, what people will do is a custodian to custodian transfer. It's not taxable, and just move from IRA to IRA, no problem at all. Not taxable, super quick, maximum 2 weeks to get that done.
Yeah, yeah, yeah. How long should it take to roll over to a self-directed and then invest into like a syndication, start to finish?
Yeah, I mean, in my time in the industry, the fastest I've ever seen it happen is 4 days from
That's really quick.
yeah,
And that's rolling over from an old custodian to you
it
and then
is.
into a syndication.
Yeah.
Wow, that's fast.
And I've talked to lots of people in the industry, and I haven't heard anybody do it faster than 4 day. We've done a couple 4-day, and so that's the best case scenario. But typically, you open an account, takes 15 minutes, you fund it. You might be waiting 2 weeks for that other custodian to move the money over, but during that 2 weeks, we're working with you, getting everything queued up. So the minute the money comes in, usually if it's a wire, then it's available the next day. We send it out, and now you've self-directed. So I plan on 2 weeks for a self-directed
Yeah.
asset.
Big news recently with the 100% bonus depreciation. Where are we at with that?
Well, that would be a tax question. I think from what I understand from talking to Amanda Hahn, that it is on the table. It's not a done deal.
Not a done deal yet. It's not official. I've heard from several sources that it's like very close. I'm gonna look it up right now as we
Isn't it
speak.
in the
I'm
bill that
just
just
I'm
got
just kind of
presented?
curious. 100% bonus depreciation. Let's look it up.
Are you looking to
100%
buy
bonus
a
depreciation.
new big vehicle?
No,
Yeah.
I'm just curious because obviously this year's the step down is 40, which is a big difference than 60 or 80. And I'm just kind of curious where we are with that. So as this article is actually 4 minutes old. The 2026 budget passed by the House includes a revival of 100% bonus depreciation through
Sweet.
2029,
Just now.
and for the first time extends the tax break to physical real estate used for manufacturing. Okay, so let's see here. Is there any other news? So after the House, where does it go? That's what I want to know. Okay, extending 100% bonus depreciation for qualifying property acquired in January 20th, 2025 through December 31st, 2029, reinstating immediate expensing of domestic research and experimental expenditures for tax years 25 through 29, and reinstating a modified version of the overall limitation or itemized deduction. Okay, so we'll have to look into this. I don't know if it's official, but it sounds like it's almost there.
Did you say it cleared the House?
It cleared the House.
Then it goes to the Senate, right?
Then it goes to the Senate, and then it will be official.
And then it gets signed, yeah.
Okay, got it. And is the Senate controlled? The Senate's controlled by Republicans now, right? Okay, so it sounds like the odds are it's likely going to happen. And I think the takeaway is for the listeners, 100% bonus depreciation comes back, and that's just going to make investing in real estate even more appealing, more attractive. I think on average, if you guys buy a piece of real estate, you get a cost segregation study done with 100% bonus depreciation. You're looking at anywhere from 30, sometimes even 50% of the purchase price of that property coming back in depreciation. Think about that. That's a huge number. And if you're only putting down a fraction down, that's a huge tax write-off.
And my understanding is that's outside the IRA with your personal cash. It's not inside the IRA. You don't get to take advantage of that.
Yes, but you
Yeah.
can use the depreciation to offset your UBIT taxes, right?
If you've borrowed money, yes.
If you borrowed money. So, I mean, I think that's a big play. I think there's a lot of like good policies that are going to be put on the books. What else we need to happen this year and next year is we need the Fed to start reducing the rate a little bit.
Yeah,
That
I mean, it would
starts
be great
happening.
for
Watch out.
everybody, right? I mean, like all the foreign countries that owe debt to the United States are paying that high rate. I mean, it's relatively high,
Yes.
not historically, but yeah. I mean, it would help other foreign countries as well.
Yeah. Kaaren, do you do any investing in real estate directly?
I
on
do.
your
I
own?
have some single family rentals, like, and I love that space.
Yeah,
I just love like the fixing up of it. It's
totally.
super fun.
Long-term rentals?
Long-term rentals,
Okay.
right? And I've got some precious metals, and a couple of syndications, a few notes out there, because I meet great people who have opportunities and invest with them.
And I didn't know this until before we started recording, but you were a radio announcer.
I was, yeah, for
You-
17 years.
You got the voice for it. And what
Thanks.
radio station did you work with?
I worked, I started in Flagstaff, where I went to college. I went to Phoenix, K-Light, KZOK. Actually Seattle, KZOK.
Okay.
I did middays, right? 10 a.m. to 3 p.m. So the morning show was the Kent and Jimmy show, and Jimmy was Jimmy Kimmel.
Whoa, no way.
Yeah.
That is so cool.
Yeah.
That
He
is
was the
so cool.
sidekick way back in that day.
Wow, that is so cool. And why'd you get out of the industry?
Because, like everybody, I realized the place to really make money is in real estate. I made that logical transition from radio to real estate because you just see, we all want to have a good life. I read Think and Grow Rich. It just opened my mind, and I got into mortgage then, and I just saw the path forward. This is how I get there.
Yeah,
And now I'm there. So
absolutely. You live in Orange County, right up the road. What are your thoughts on Grant Cardone running for governor?
personally, my personal opinion,
Yes.
all the way. Go
Yes.
for it. Yeah, this guy is on fire. And he seems to he's got the fire in his belly after experiencing the fires and what's going on there. A lot of people aren't happy about that. And I've heard him speak publicly and just, rallying the cause. I mean, there's some things that could be reformed in California.
A
I'm sure I'm
lot,
not
a
alone on
lot.
that one.
I mean, the Malibu fires happened, and it's been, what, 5 months now, going on 6 months, and nothing's been cleaned up. Nothing's happened. No progress. But yeah, I knew, and he didn't come out and publicly say this initially, but like I knew 4 months ago when he was going up and down the California coast doing sometimes 2, sometimes even 3 rallies. I'm like, I know at age 67, you don't do that for fun. And so, yeah, I'm excited. I think it'll be a big thing if he does win. If he does get elected, I think they'll be big for California. And it will be big for attracting a lot to come
Let's
back
bring
this
them
way. It'd be good
back.
for the economy.
Yeah, it would be great. I mean, a lot of things happen. Like a friend of mine, moved out of California to Florida, and the reason he did this is he said there's this new law, and he says I don't remember voting for that. That things are happening without public approval, and that's nuts. I mean, we need to have law, is my
We do.
opinion.
We do. Let's bring back some more business-friendly policies here in California. Let's cut out a lot of the bureaucracy and the red tape, and let's lower some state income tax here. 13% is a little bit too high. Let's reduce that a little bit. I think property taxes are fair. It's about 1.1. That's not bad. But I think we do that. We figure out a way to get state income tax from like 13 to like 5 or 6. I think that would make it a lot more attractive for a lot of people to come back out here to California.
Yeah, our state
And
income tax is the
don't
highest, right?
it is, yeah. And we're one of only so many states that have property taxes, state income tax, and sales tax. Most states have 2 of the 3. We're one of the only that have all 3.
The trifecta.
The trifecta. Kaaren, I appreciate you coming on the show today,
Thank
dropping
you.
so much game. Where can the folks get in touch with you if they want to learn more about transferring their IRAs and transferring their 401ks over to your self-directed IRA firm, uDirect IRA Services?
Well, how do you like this? It's udirectira.com/Rich Summers.
Oh, I like that. I like that. For your special podcast listener intro right there. And by the way, if they do it, do they get a special call with you, or is it one of your team members?
They'll probably talk to a team member
Okay.
because I'm out doing other things
You're
typically.
busy. You're busy
Yeah,
promoting.
but if they go through that channel, then what we'll do is we'll give them a free book. How about that?
Free book. I
Yeah.
love it. And what's the name of your book?
It is The Bigger Pockets Guide to Self-Directed IRA Investing. Just came out this year. So
Ooh, I
yeah,
like that.
yeah.
And on Bigger Pockets. You guys heard that. What's the website again?
It's udirectira.com/Rich Summers.
And go get your free copy of her book with Bigger Pockets. She's Kaaren Hall. Appreciate you. Always looking fly. And by the way, loving the fit, Kaaren. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.